Right, I think we'll kick off this evening. Thank you, hello, welcome to this wonderful, probably one of the nicest, most interesting installations I've ever been to for a talk. I may be distracted by looking around aimlessly. It's not that I'm not considering points, I'm just distracted by all the interesting parts. Thank you for attending tonight's event, hosted and organised by the North East London Fabians Society on Driven into Debt. I'll be your chair this evening. My name is Bilal Mahmood. Tackling the growing crisis of consumer debt is a somewhat, as some people describe, somewhat of a boring topic to many, but is actually fundamental and instrumental to both the poverty line within the UK, how society is made up, the cost of living, and also about general mobility of young people and of families trying to develop a future for themselves. Recent figures and studies say that employment's on the up. A lot of that probably has to do with gig economies and contract work. But despite that, we've had some of the highest rates of personal insolvency in the past 7 years. So clearly there's a disconnect between how much people are earning, how they're spending it, and what they're spending it on. So people who are in work now, who are relying on getting themselves out of the cost of funding crisis, whose necks are just above the waterline, are arguably being dragged down by the anchor of personal debt, making it almost an impossible task to get ahead, to save for their futures and their families. And as we'll discuss with our speakers this evening, most studies and research and evidence points towards that this scourge disproportionately affects the poorest in society, as with all these things. So there's three key areas of discussion this evening that we'll be looking at, and they're very basic. What exactly are we talking about? How big of a deal is this idea of personal debt? The second one is, why does it happen? Looking at the underlying causes to see if there's roots that we can find and identify. And the third one is, what can be done, both from the Fabian Society, from policy base, and even through community activism. We have some excellent speakers who've got lots of ideas, and most of you know already some of the work that they've looked upon. But before I introduce my speakers and before I introduce a movie, there's a few household tips or housekeeping tips. The first is we are being recorded. So just people are aware, if you have an issue with that, perhaps Mitch, if you want to raise your hand, if you want to have a conversation with Mitch afterwards about that, please let him know. You hopefully all have our wonderful handout about future upcoming events. I won't direct your attention to them now because I want your undivided attention to this one, but by all means do peruse and join us again for one of those. And I'd like to now turn to introduce our speakers, and our two of them. First and foremost, we have Stella Creasy, a Member of Parliament from Walthamstow. She is, as I describe, our campaigner's campaigner. She's been at the vanguard of some of the most important, I think, social causes in the past 10 years, whether it be defending the rights of abortion rights in Northern Ireland, whether it be tackling online abuse for all sorts of societies, for ensuring the representation of, for ensuring maternity rights for our elected representatives. But I think that the main campaign that I remember Stella from was from tackling payday lenders on our very own high street. So please welcome Stella Creasy. I'd like to introduce Damon Gibbons as well, the director for the Centre of Responsible Credit, also an author on personal debt as well, who'll be talking to us much more on the focused policies, particularly, as I understand it, around rent flex, which is a fantastic new idea, around cash flows relating to rental incomes for low-income families, and talking about some of the new ideas that are working around cash flows, particularly around personal debt. So welcome, Damon. That feels like a really excellent place as a launching pad to look at the first area to discuss and explore, and maybe it's worth sharing some experiences as well about what's the extent of this problem. The Fabians, through the organising Step Change, looking around 22,000 people alone in Woodland Forest are suffering from struggling with personal debt. Across the country, that's something around 9.3 million people who are relying on credit to cover everyday costs. So it's one thing to borrow for a new car or for a mortgage, but it's another one to keep paying bills as well. So it's debt upon debt, which creates a vicious cycle. And as we discussed earlier, the FCA focuses on people who does this affect the most and the worst, and it's usually people who are on low incomes, people with no savings, people who are renters, and people who are from the lowest income parts of society, and of course has a detrimental effect on these areas. Let's isolate the problem first before it because it feels like it could snowball into everything, but it permeates all parts of everything. How big of a problem is this, and is it going to get worse soon?
It's big. If you want to put some figures on that, then you're in the region of sort of £250 billion, which is big. So that's just consumer credit that's outstanding. So we're not including mortgages, we're not including student loans, and of course that's a big problem of its own as well. So things like credit cards, bank loans, overdrafts, payday loans, all the sort of stuff that's going on out there. So yeah, about £250 billion worth or such. It's the highest it's ever been. So it's certainly not getting better. Are we going to be looking at that for a long time? Well, yes, frankly. In terms of where that debt is concentrated in society and the levels of income that people have got, it's not just the very poorest. It does extend up the income scale to low to middle households, and indeed even some quite wealthy households use credit. In terms of the amount of credit nominally that households use, richer households get more access to bigger amounts of credit, as you might expect. The problem is they pay very little interest on that relative to the amounts that are being borrowed by poorer households. So that one of the problems is that the people on lower incomes are paying the most for credit, and they're the least able to afford to do so. So what's it going to take to turn that around? I think there's a couple of things we could talk about, and Stella's been leading the campaigns on all of this, in terms of more responsible lending, in terms of fairer pricing, in terms of alternatives to credit as well. So yeah, just to put it in perspective, I mean, the interest payments alone, if you take a very rule of thumb, are about 10% of the 250 billion. So that's £25 billion per year going out of households just to service the interest, which is a huge extraction of income from communities as well as individual households. And it affects everything around us in terms of how much people can afford to spend locally and what the high streets look like and what the feel of the place actually is.
And just, this is my own curiosity, of the debt that's being drawn down, what's it being used for? Is it to be used to pay down more debt, or is it for household income spending? Is it for one-off costs like extensions, or do we have any data on that?
Well, no, not good data. We do know increasingly there have been surveys or step change, and some of the debt charities will talk about debt that's being taken out for everyday spending purposes. So we've got some information about that. But we also know that a lot of debt is basically recycled debt. It's used to pay off previous agreements, and credit cards is the classic for that. Because clearly you can balance transfer to pay off a previous transfer, and all of those sorts of things, and that's been going on for many years. But what we don't have a good sense of is exactly how much debt is being used to pay off how much debt previously, and how long a cycle, the chain of debt, has actually been going on for. And that's quite shocking. You would think that we would know that. You'd think that the regulators and so forth would be keeping and presenting statistics around that. I'd also say you would think there would be a target to reduce the amount of debt that households actually hold, or specifically that lower income households we should be trying to aim to reduce the debt. We all know that debt is a big problem. We all know it's got huge personal and community effects for people in debt, and yet we don't even have a target to do anything specific to reduce that, which is bizarre.
And just on that wider community point, so on the campaigns that you were working on, how did you experience and see the wider effects on the community? So it's one thing of how debt affects people in a household, but how does that permeate to everyday life and with your neighbours and with wider communities?
So one of the reasons I think it's really good that we're doing this in here, and I actually negotiated with the co-op for us to get this building, partly because when I was first selected in 2010, moving through to 2012, we went up to 18 payday lenders in Walthamstow alone on our high streets. I used to walk around counting them off versus the chicken shops and the off licences. And in fact, there was one exactly opposite here in the building that is now the Citizens' Advice, and that gives me a huge amount of pleasure every day to see that. And what that reflected is something I think it's quite important that we recognise in this conversation, because borrowing in itself isn't necessarily a bad thing to do. It's borrowing in a way that actually is going to get you into debt, and what I would call predatory lending that is the problem. So basically, as Damon's saying, it's lending to people, and I think it was in the film, lending to people in a way that means they'll never ever be free of debt, rather than as part of a contract in which you help somebody manage their costs. And I think it's really important that we differentiate, because there are good forms of credit out there, but at the time that we were challenging what was then the kind of newest form of predatory lending, and predatory lending has been with us for generations. People will know of doorstep lending, they'll know of hire purchase agreements, but the payday lenders and the kind of online and the offline sort of short-term money lending, we had one credit union that was just round the corner from here versus all of those 18. And the challenge we've got in this country at the moment is it is not a fair fight. And it's not a fair fight both because we have got a community, a particular community like this, where there's just too much month at the end of a lot of people's money. So the people who would come to my surgeries, maybe they come to the key one, my local cancer surgeries, would come and they'd say to me, I'm about to lose my house next week because I'm being evicted. And really I could do very little for them at that point because it was so late on in the debt cycle. But when you talked to them and when you drilled down to what forms of credit they had very little good credit, they had an awful lot of bad credit that was driving them further into debt. I mean, I would say, Damon, I don't know if you've seen the stuff that R3, who are the insolvency practitioners, have done, but they actually were tracking why people were saying they were in debt they couldn't manage, and a third of those people said they were in debt they couldn't manage because of previous debts. And on a very practical basis, I see and hear that still every day in this community. In 2010 to 2013-14, payday lending came up repeatedly. It was part of a debt profile that people had. Now it's different forms of debt. So for example, on Friday I did a surgery and I had a gentleman who came who had four credit cards for which he owed in total £40,000 from mainstream banks. And he's essentially what we would call a zombie debtor. So I think about 1 in 7 people in this country is a zombie debtor, where they're paying off the interest but not the capital on a loan. And we have to ask ourselves, in an environment when people are being offered predatory lending and predatory credit, and you have a kind of 18-to-1 ratio, is it a fair fight to expect people who don't have much money and are borrowing absolutely to put food on their table, to get a roof above their head? I mean, it was ridiculous numbers of people who were putting their mortgages on a payday loan, let alone their rent on a payday loan. Actually, is it fair to expect them to try and manage the implications of that when they've got very little access to what you'd call good credit, and they are being challenged and targeted by people lending in a predatory way?
I think there's, for me as well, what that strikes is that you think of predatory lenders as payday lenders or specific types of people, but it's not necessarily who's lending, it's the product, it's the context, it's the person who's borrowing. So credit card debt, which is you can see as a normal or kind of household, I would say friendly form of debt that people think is perfectly normal, actually in certain contexts it's just
one of the reasons I actually have a problem. I mean, thanks to people like Damon, who I've been working with for many years now, who's been an absolute mine of information and help and support with the work that we've done, because at the time trying to challenge predatory lending was seen as an unheard of thing to do. But one of the problems I've always had is the concept of problem debt, because often I'll talk to people in Walthamstow and I'll say, you know, they'll come to you about financial difficulty and say, well, do you have any debt? And they'll say, no, I don't. I'll say, do you have a credit card? And they say, well, yes, obviously. That actually what we perceive to be a problem, what we perceive to be a acceptable type of credit, and we'll be honest about it, one of the reasons we were successful in the fight against payday lending is we were able to call these people what they were, which was legal loan sharks, and it started people looking at the data and it started people realising just how damaging these companies were. But I see similar predatory behaviour in forms of lending that people would think of as socially acceptable, because we have a credit kind of profile in this country that says until people are in problem debt, there's not a problem. But the problem in itself is that it's not a fair fight. And for me, and I think for Damon too, and why we've continued to work on this and why as I say, I didn't just want this not to become another payday lender, but I also wanted this building to be used by the community, is that unless we challenge that way of thinking, unless we are able not to differentiate between people being in a debt they can't get out of and people being in debt, but actually say, what kind of credit do you have? Because if something goes wrong, if the washing machine breaks down and you've got to find the money to repair it, if you need to get a new school uniform for your kids, what might seem like a socially acceptable debt is still going to cause you a problem. We just haven't called it problem debt. Then actually the problems that we see right now with regulation will continue, because people will say, well, they're not in problem debt because they can afford to repay it, when the reality is actually they are a heartbeat away from being in that spiral.
I think that's a really good point. There's many good points in that, Stella. I mean, I think one of the interesting paradoxes about credit is that no matter how much you are in debt, technically you could still do something useful with credit. So if you've not got a washing machine and you're going to the laundrette all the time to wash your kids' clothes, it's very expensive. So even though you might already be in a huge amount of debt, that person would still benefit if they were to take a loan and get a washing machine and cut their costs. Similarly, if you take out an insurance on a car, if you take it in instalments, you pay more. If you're able to pay in a lump sum as a one-off, you save money. And there are lots of ways in which credit could be used productively, if you want to use that phrase, or helpfully for people. The problem is simple in that it depends how much you end up paying for that credit, because ultimately the cost of credit is the split between what the creditor gets out of you using credit well and the amount you get out of using credit well. So if you're going to charge 85%, then you're only going to get 15% of whatever you've managed to use the credit for. And in many cases, obviously, it's over 100%. Now, that basically means you can't do anything with it that is actually going to be beneficial to you, other than if you're in a case where you're so desperate to feed yourself or stay alive, you will take that bad loan, that high cost loan. So I think when we think about credit, we've got to start thinking about there is actually a cost of credit at which it just becomes ludicrous to expect people to benefit from it. So the first thing is the cost of that. The second thing that I think you're quite right is it's the nature of the relationship between the lender and the borrower, which is also very important. And the reason why Legal Loan Sharks was a great campaign slogan, all credit to you for that one, I didn't come up with any of that, just do figures. But the reason why that stuck was because it clearly nails on the fact that it is an exploitative relationship. So it's a long-term relationship of trapping borrowers in an exploitative one, and ultimately the credit has no real benefit for the borrower as a result of that. And it's those sorts of credit agreements and those sorts of credit behaviours that we need to really get to grips with.
We also understand that as a form of market failure, because often I would talk to people who say, well, of course it makes no sense for these companies to put people in a position where they go bust. And you say, yeah, but they're not pushing them in a position where they go completely bust. They're putting them at the edge of being so broke it was the only way they could keep ends meeting. So I would meet people who would have taken out a payday loan for 1 month and they'd take it out on, say, day 28, and then the next month they'd take it out on day 26 and day 21 because of the impact of the previous loan. And it took 2-3 years to prove to the government that the whole of the business model was not about lending to people who were high risk. It was about getting into a relationship with people that was counterintuitive if you were thinking this is about effective markets. And one of the things I think we have to recognise when it comes to credit is that our credit market isn't driven by profits, it's driven by behaviour. And that's behaviour both in terms of these companies, in terms of where can they make the most money the quickest, but also the ways in which people in this country, and I think it's a peculiarly British thing, approach being in debt. So the fact that people wouldn't say to people, look, I've got a debt problem, the people wouldn't see a credit card as a debt problem, the fact that they would rather be online, in particular, in a private space, taking out more money, even though they knew how expensive. I never met anybody in Walthamstow who didn't know how much debt they were in and didn't know it was a problem. They just didn't feel they had any alternative. But because there was that sense of shame about it and shame of borrowing, it was easier to do these things, and it was easier in terms of behavioural terms to manage whatever embarrassment you might feel that maybe you couldn't feed your kids, or you wouldn't want to go to the food bank because that was a public thing as opposed to a private debt that you could get into. And I think these lenders, and I think banks as well, benefit from that experience in being Britain. I mean, the irony to me at the moment, there's a bank running a kind of advertising campaign about people can talk about sex and politics in Britain, but they can't talk about money. And I think, yeah, but one of the reasons you've made a lot of money is because we are a culture where people can't talk about their finances, their outgoings, their budgets, where we didn't have financial education in schools, where we had an attitude towards being in debt that it was so shameful, people waited until they were about to lose their home before seeking help. And of course, the sooner you see somebody who's struggling, the sooner you can help them. And the predatory lending process lives within that. It lives within people needing to make ends meet.
I think, can I just add something slightly on to the end of that? Because I think one of the reasons why people don't seek help about debt is also because that credit is seen as so important to them. In other words, that to go for debt advice or to enter some sort of debt remedy effectively means you're defaulting on debt, and that you will then have more problems getting access to credit later. So everybody wants to defer the date on which they're actually going to own up to the fact that they're going to have to stop using credit, or accept that there's going to be a period of years when they won't be able to get a mortgage, or they won't be able to cope without credit. So the problem for that is that our debt remedies, such as they are, don't actually get rid of debt very quickly, and they don't enable people to repair and become rehabilitated in terms of their credit scores very quickly. And that all weighs on people's minds in terms of, well, I'm going to have to keep recycling my debt rather than go and get a remedy that will sort that out, and I know I'll come out of that within a reasonable period of time, and I can pick myself up again.
I think it's very telling, because from a corporate finance world as well, big companies use restructurings and revisions of debt as an opportunity to get more empowered.
Yeah.
They see it as a cycle of every 5 years or 3 years to build in a chance to say, we can negotiate better terms, and actually helps, counterintuitively, helps their credit ratings in many ways. And so you can see the vast difference between how corporations and large companies approach and are treated with their debt. They are seen as an asset or a potential client, versus everyday people where, unless you go and say, I need to restructure, or I need to do some help earlier on, you're seen as kind of almost a social prior, or internalise a sense of social priorness.
Well, there's also, the irony about that model is at the moment there are credit cards for people who have bad debt profiles, and you'll have seen them in Walthamstow Town Centre. There's Vanquis and there's Aqua, and they make a virtue of the fact they're selling to people who might have previous, so they'll lend to you in a way that somebody else won't do, because it will help you improve your credit rating. But what they mean is you will become more attractive to people to lend more money to because you've borrowed from them. So they push people, so they start with sort of £1,000 limit, and then they're quickly offering people £1,500, £2,000 limit. But again, it's not actually about helping you out, it's about hooking you into a relationship. So it's just a different form of predatory lending. And I think you did the calculations, Damon, that actually you would end up owing more. The irony now is you are better protected if you take out a payday loan in terms of stopping that cycle than you are taking out one of these credit cards, which is marketed as helping you restructure your debts and rebuild your credit score.
I'm keen to get the audience involved in that. I think we moved on to 2 areas. So what are we talking about, and why are the reasons of these happening? I'm keen to hear experiences of what you think and you perceive to be the main root of the problems, why this is happening. Any questions for either Stella or Damon? I would like to encourage anything. Mitch?
I have some stories from people. They're in a manageable level of debt, but then they have an unexpected life event. So somebody gets ill, they have to refit their house to accommodate their disability, or they lose their job suddenly, and they fall into the cycle. Is that a common experience you'd say, or is it? Yeah,
I mean, if you look, I started as a debt advice worker in 1990, so it's sort of like I've got a bit of experience about what's happened over those years in terms of credit use, and that was certainly the major cause of debt problems, were those sorts of life events, including unemployment, illness, relationship breakdown, big things. that happened, and so most debt advice was structured around the idea that this would be a temporary problem for somebody, and that they could be helped out of that problem as things were resolved and get back up on their feet again in terms of debt repayments. What sort of changed, I think, probably from around certainly the early 2000s onwards, was that more and more people were basically over-indebted without necessarily having had one of those sort of major life events happen to them. That they were using credit, taking on more credit than they had previously done so, or we were as a nation. And I think that issue about how credit was promoted to households and the reasons why they did that around that sort of point in time, financial pressures on them to do that is quite an interesting one. But fundamentally behind that is a lack of responsibility in lending. So in other words, lenders were prepared to lend more than households probably could reasonably afford. And that comes back to the issue that actually it suits them to keep people in a recycling of debt and actually, on the wheel for as long as possible. And that was a big change, that fundamentally we did not get to grips with stopping lenders making unaffordable loans. And just to cap that out, often the credit industry at that time would say, well, we're lenders, why would we lend to somebody who can't afford to pay us back? Actually, the point is, you're lending to people who will pay you back, even though they can't afford it. Because what that's doing is it's having a knock-on effect in other areas, like rent arrears or council tax arrears or those sorts of things. That's where, if you like, in economic terms, the externalities of your bad practice are to be found. Yeah. So fundamentally, the lending decisions, credit scores, and all the rest of it are based on an assessment of whether somebody will continue to pay back and will pay back for a long time, and how profitable they'll be in terms of their financial behaviours. It is not about preventing people from being given loans when they can't afford.
I think it's also, I would agree with absolutely Damien, that the lenders got into a practice of unsecured consumer credit being readily available, and the external consequence of that being picked up by the state, because obviously if someone got into council tax arrears or rent arrears, it was us who would pick that up. What also has happened that has particularly changed the debt profile, that 250 billion is now higher than prior to the recession in this country, has been that, we can't talk about debt in this country without talking about austerity, because actually cutting so much to support the tax credit cuts, the welfare cuts, plus the lower incomes that people have had and higher prices, like I say, just too much month at the end of people's money. So increasingly what I've seen is not people borrowing because they got into a single episode of something that hit their finances, but because they got into a pattern of that was how you balance the books. And actually it has normalised, if you look at some of the online apps that these companies have, is these online companies create a huge amount of data on people, and they are spotting those patterns. So they're coming to you just at the point when they know you're going to be, say, day 26, day 25, going, it's okay, we're here for you, almost offering themselves a social service. They've also particularly targeted, people, again, think of predatory lending as something that only happens to people on very low incomes. They've targeted people on those middle incomes, middle class people in this country, because it's been about, this is a way of coping without anybody seeing. And those are the people, if you think about this as a community that had a lot of people who worked in the public sector in 2010, 11, 12, a lot of those people lost their jobs. A lot of them now are self-employed, so they're earning less than they were already, and inflation has already gone up. They are much more of a prime target because they are people who tend to have assets. So they have houses, they have small amounts of savings. Most people now don't have any savings at all. So even if a shock did come, they're already in debt.
Any more contributions or questions?
I know that the credit unions have a much lower market segment in the UK compared to, say, America or Ireland.
Yeah.
Why do you think that is? And what do you think strengthening credit unions is a good idea? And if so, how do we do it?
I get very
Do you
angry.
want to go with that one?
Yeah, I get very angry. I'm a co-op as well as Labour MP. I've done a lot of work with the credit unions. But I sit in meetings with government ministers talking about how we can learn the lessons of credit capping, and they say, no, what we need is more affordable credit. And I think of that 18-to-1 ratio. I think of credit unions which have expanded substantially in this country, but are nowhere near being at a point where they could compete, not just in terms of the technology, in terms of the reach, in terms of the access. I think of 2011-12 when we were given promises that the post office sector would join up with credit unions because it would save post office. We wouldn't have lost our main post office, which is also now part of a bargain booze down the road. None of that happened. So none of the investment happened. A lot of our credit union sector is in it's not all the same. So you've got some very big credit unions that are really well financed and really stable. You've got some not so much. So the idea that somehow the answer to that kind of predatory lending is affordable credit it's an excuse rather than a reality. Absolutely, we need to do a lot more, and you could do things. We tried to get ministers to pick up schemes about people having credit unions through their workplaces. We tried to get people to work with public sector organisations who would encourage people to take out loans with credit unions so that could sponsor lending. But if you want to stop this and you want to stop predatory lending, there is a silver bullet, and it is capping, because it's not the credit union movement. We should support the credit union movement for a separate process.
Can I just make a couple? I agree with everything that's been said. There's a couple of things I might add to it. The first thing is that the model of credit unions is to take quite small deposits from people, savings, and turn it into quite small loans to people, and to try to make a profit on the margin. It's the old banking model, if you like, from maybe the 1950s. And it's the reason why the banks got fed up with that model is it's a recipe for quite slow growth. So, to make a margin, you're not going to make a lot of margin on each loan, and then you've got to take, all of that sort of stuff. The other problem is that if credit unions are going to serve people on the lowest or very low incomes, then they're going to have to cover the fact that there is a risk involved in that people won't be able to afford to pay them back, or actually probably more likely that people on low incomes experience problems more often than people on high incomes, which probably goes without saying really, because they're more likely to be made unemployed or have changes of hours, or those sorts of things. They're not going to have savings buffers. So there's the risk involved, but then equally you're asking those people who are on the lowest incomes to also pay for an entirely new small-scale infrastructure to deliver the loans to them as well. And you're going to do that by making a tiny margin out of it. So the whole thing, I think, is set up with real problems. And the reason why in the US credit unions become much bigger is because they moved upstream. They didn't want necessarily to serve the people on the very lowest incomes. They actually moved up into sort of middle income sort of territory, made much bigger loans, and also got involved in the securitisation of loans, whereby they could sell them off as investment vehicles and raise money that way. A lot of them got into trouble in the financial crisis. Credit unions in the States were, up to their necks in it, in many cases, just as the banks were. So there is a pressure, a tension between credit unions sticking to the mission of serving people on really low incomes, in which case it's really difficult at the moment to make that a sustainable business, or actually going up the other route, which is actually growth, but moving away from perhaps the communities that need it most.
I'm going to use my prerogative as well, because I'm actually director of the East London Credit Union, which is the credit union which was the Waltham Forest one, which has moved down the street. And I think I echo exactly what Damon's sentiments are on that, is that in this country, credit unions aren't resourced to take on high street banks for those economies of scales. We cap our loans at, I think, £5,000. We aren't in the business of lending large amounts of people as an alternative to payday lenders. What we are focused on, says our mission statement, is actually to focus people on saving, particularly young people, on junior savers. So if there is a contribution, I believe, for credit unions in the future of this country, it's more about financial education and starting the idea of saving at an early age on to grow that. We do take deposits and we do lend, but we're in the business of lending, but as Damon said, not to make a lot of money from it. It's more because people will need it. It's often lots of micro loans. We've explored the idea of lending to more, say, I'd say middle class, weather off people in Walthamstow, to help them assist with their new businesses. Now, while that's gained some attention and traction, it's a very small part, simply because those people are, for good or bad, have access to their high street lenders with preferential rates, with really good fancy banking apps with loads of branches, but are also staying within that predatory culture, as it were, of lending. So I think if there is a future for credit union, for me, I think it's more about encouraging people about the ideas and the importance and values of saving more than anything else. But that's all. Phil.
You mentioned the different positions of credit unions in the States. And as I understand it, one of the other differences that's relevant, could be relevant, is the attitude to bankruptcy. And I just wonder whether there's room for consideration changing our position. I don't know really how much it is a question of simply social attitudes, which are much more accepting in America, as I understand, that, you know, okay, you go bankrupt, you get discharged, and you start again.
Yeah.
What impact would a change in that attitude and whatever necessary change in regulation were needed, what effect might that potentially have on this type of debt, this eternal debt?
I think you're raising some really good points. It actually in some ways comes back to the bank job film, which I'll try and bring in as well. The first thing is that in America, as here, we have the policy position that people should be able to get a fresh start. Right? So it's the same, technically, policy ambition in the States as it is here. In the States, however, they have a form of bankruptcy, I think it's Chapter 11 bankruptcy, whereby you can maintain your main residence if you go bankrupt. It's not, you don't have to sell your house, basically.
Right.
Yeah. Whereas here, there is a real risk, and it's actually quite uncertain in many cases, as to what will happen to somebody's house if they go bankrupt. In most cases, it is an asset, and the official receiver will force a sale. You could go through an individual voluntary arrangement, which is supposed to be our version of Chapter 11, but actually there's massive uncertainty for people entering into those schemes as to A, how long they'll be paying the IVA for, making payments under it, and B, whether or not there will still at the end of that process be a charge that's placed on their property anyway. So these conditions, restrictions if you like, to our insolvency route for people who are mortgage borrowers has meant that lots of them would not prefer to go through insolvency, but would much rather prefer to come to a long-term debt management repayment plan, which is not a statutory, although there are moves to make it so, but it's not currently a statutory provision. So this is just something that the debt advice industry, together with the creditors, have created as an alternative for these people so that they don't need to go through bankruptcy and lose their homes. The difficulty with that is these debt management plans last years, and they have no write-off of any amount of the debt, whether it's a partial one or not. So people end up on these debt management plans for what can be a very, very long time, effectively paying out small sums of money, often for years and years. A lot of that debt, by the time it ends up on the debt management plan, it has been sold by the original lender, bought up by a vulture fund in effect, but debt collection agency that purchases debt for tuppence in the pound, at a real knockdown price. They've bought it for nothing, and yet that debt, which is costing 2% of its nominal value in most cases, is going to be collected out for 100% through the debt advice services. And the debt advice services in some cases get a share of the amount that they collect through that process back from the creditors to fund the provision. So I'm not sure what model that is, but it's certainly not a very sensible model in terms of giving people the policy ambition of a fresh start. Yeah. So I think we've really seriously got to look at that. There would be nothing, for example, to stop debt advice agencies being provided with a fund to buy out all of that secondary debt at tuppence in the pound, which would then at least give a partial write-off for people for all the stuff that had been sold in that market, and they just paid back, the remainders that were left after that, and the amount of the that have been put into them through that fund. So in other words, they pay back 2% of the debt plus whatever the administration fee was. That would be a lot easier. They'd be out of debt a lot quicker. The other problem that we've got, just to put it on the table, is around debt relief orders. So there is an insolvency route for people who have no income and no assets. It's called a debt relief order. You have to go to it through a debt advice agency, but they can apply for that, and it's a form of insolvency that writes your debts off after a year. It's a very good, simple procedure. It ensures people get advice, and they get their debts off at the end of it. The problem is there's an upper limit on it. So those people who have no income and no assets and who are the most in debt can't get it. Which again, you'd have to wonder at the wisdom of that policy.
There's been some recent news, so I think it was yesterday we had a statement from the government, they call it sort of breathing space, and a lot of the stuff that the government is doing, because they're refusing to look at kind of more market interventions, is about this concept of affordability, and it is about what intervention is supposed to be. And they're arguing that people who, in some sense, it's about the right way. If someone goes and tries to get debt advice, tries to kind of get their debts in order, that should mean something. The challenge at the moment is that there aren't actually access to debt advice that isn't predatory. And I mean, as Damon says, some of these companies are incredibly predatory. So they're kind of sticking people into a cycle which says, okay, now you've got a problem, we're going to tell you that you've got a problem and tell you something about it, but we're still going to make you pay. Fundamentally, the heart of the problem is you borrowed at a rate that was too expensive for you to be able to manage. And until we crack people's understanding that the problem is the rate, that it's the predatory credit data, then we're going to keep seeing solutions coming from government that aren't funded properly because there's just not enough access to debt. Like the numbers of people I'm referring to try and get their debts managed early, there's a great big long queue for the CAB, and obviously again in 2010 we had 3 CABs in this borough. We've now gone down to 1. All of these ideas about trying to move people away from bankruptcy because there's such a stigma on it, because the formal measures can affect your credit score and therefore affect you for a long time, aren't going to work. So more and more people are getting into IVAs and into bankruptcy without some of the earlier interventions that might actually lead to some cheaper costs. It's a cycle.
So I think we've moved now quite comfortably onto what can be done. We've explored. I had a list of things that we could talk about. We've covered credit unions already, breathing space has already been talked about, financial education, and better debt advice and access. One thing I want to talk to you about, David, about is the rent flex idea. Mitch was introducing it to me, and I think it's a fantastic one. And it focuses on something that we don't often talk about, which is cash flow, particularly. Yeah. And it does with payday lenders. So it's not just how much money you're making, how much you're paying off, it's about the timings of those payments. And I think rent flex talks about those externalities that you referred to, which is even though lenders can say, look, you can pay our debt off, it's everything else. So if you wouldn't mind, could you give us a quick introduction to rent flex and why you think it's beneficial?
Yeah, sure. So can I just sort of say, we're very excited about this.
Everybody
I speak to gets very excited about it. It's still very early stages, all right? So let's not get overexcited about it at this point in time. But fundamentally, it's the recognition that people borrow either because they have a cash flow problem caused by income changes, or actually for a lot of people, and that can be unpredictable, what's going to happen on income side of things. But actually a lot of people also borrow for fairly reasonably predictable expenditure pressures over the time of year. So, long school summer holidays. People got kids off, they've got to look after them, you've got to do things with them, you've got to feed them, all of that sort of stuff. Christmas, another obvious one. Or winter more generally, things are higher cost heating, etc. Back to school costs are another one as well, school uniforms and all that sort of stuff. So some of this stuff is actually reasonably predictable. You can add in some personalised stuff around all of that as well, like when the car MOT is due, or you've got to get servicing done, or when various things fall due in the year. So what we were thinking about that is, well, okay, ideally people should have enough money to put some money aside and save up for that, but people haven't got enough money for that at the moment for a variety of government policy measures. So what can we do to help people in that? The best thing that they could get, it would be a no interest, 0% interest loan to help them with that. That's the best you can do if you can't just increase their incomes or cut their costs. How can we deliver that? Well, we're not going to get somebody stumping up a load of capital to deliver 0% interest, because you're just going to lose the money. So what we thought about that was, well, you could flex their bill payments so that they paid less on other things during those times of the year, and they paid more when they're better able to afford it at various other points in the year. What would that look like if we just allowed people to personalise their bill payment schedule? And the only reason that that doesn't happen at the moment is because service providers like landlords or water companies or the council with its council tax want a steady cash flow of it all coming in as that. So the cash flow is basically driven by the service provider as an organisation's preferable cash flow, not the customer's cash flow. So we're looking at ways to personalise that. The early results from it, we trialled it with some tenants in London and South East. Only 60 or so tenants of proof of concept, or we've had that on for a year, have been really positive. So most people can manage that. There are some risks to the landlord in that if they if they underpay initially very quickly and then they're hit by a life event or a change in their income, there are some problems with that. But we think we can offset that for the landlord by mixing the demographic a bit, so that you've got cohorts of people who, some of whom are overpaying at various points in the year, some of whom are underpaying at other points at the same point, and so the balance for the cash flow works out. So I'm pleased to say we got some funding for larger scale trials, which we'll be running over the next 3 years. So we'll be getting up to sort of 1,000 plus tenants with that for a full 12 months, and we're looking at a scalable delivery model which we can then roll it out across the sector. Where you could see this going, I'll just wrap up with this, you said brief introduction, never brief with me. Where this is going is that perhaps you could imagine a sort of flex app on your phone which has got all your bill payments in it, and it's one combined amount of money that you can schedule and flex the payments of over a year and that sort of stuff. That would allow the risk to be shared between the different service providers in that flex wallet. So in the first three we reckon would be rent if it's a social landlord, council tax and your water bill, because they're long-term relationships you've got with those providers. And they would share the risk, and you'd have a pot of cash that you could flexibly use instead of using an overdraft or instead of using a credit card.
There's clearly a pot of money to be tapped into, which is the amount of money that the public sector then uses chasing people who've got into debt, and actually ends up paying more chasing those people.
Well.
And there's some really simple and stupid things that we could sort out. For example, if universal credit, if you get paid twice in a month because your payday shifts because there's 31 days in the month, universal credit will then dock you rather than recognising that it's still 1 month's worth of pay that you're getting. That gets people into debt. That means that then councils are chasing people for debt on their rent. And one of the things for me as the MP at the moment is often we end up trying to draw together people. So now, one of the challenges about this, and it's interesting you talk about the Flex app, is one of the ways that you could resolve this is sharing data, but there are clearly huge data protection implications in all of this. And I think one of the challenges for us as a society is, if this is particularly an issue for people on low or varied incomes, that you are going to end up, these are people whom a lot of creditors know an awful lot about, and then local authorities know an awful lot about. There is no interest at the moment in either of them in working together, because as far as the creditor's concerned, as long as you're paying back your loan, they don't care if that then means that you've not paid your rent and you've got into rent arrears, and therefore you can't move, for example, if you get into a rent arrears of the property where the landlord puts the rent up. So there's a kind of spiral there, but I think for us as a society we have to think very carefully about what the consequences are in terms of data and in terms of what that means for someone's privacy versus what we can do to better manage public money. Because on the flip side of this, I'd imagine there'd be lots of local authorities who if they profile how much money they spend chasing people who are in debt, paying for bailiffs, a hugely expensive process, and bailiffs are very expensive in terms of their fees. Actually, you could see where the money could come from that could subsidise a scheme like this. Yeah. But I would feel wary if we were saying to council tenants, right, the quid pro quo is that all your data has to be shared. Yeah. So there are issues we've got to...
You're absolutely right.
I think one phrase we haven't used in this entire conversation is the FCA. They've been woefully lacking in this part.
I have said regulating.
For something this important, this something that is about defending some of the most vulnerable in society, I do always find it striking when we talk about personal debt and the remedies,
Yeah.
it's either community-based or it's market-based.
Yeah.
And very rarely do we say, look, the FCA should be taking a lead role.
Yeah.
Is that because we just generally don't think they're fit for purpose on this? Do we think that they're part of the problem, or do we just not talk about them?
So Damon and I bear responsibility for the introduction of the FCA because we hunted down the Office of Fair Trading for their failure to deal with payday lenders to such an extent that the government decided they needed a new regulatory body. And I think we should be pleased with some of the things that the FCA has done. And I say this as somebody who, the FCA has been going since 2014. Finally, this week was the first week they agreed to meet with me as an MP and go through some of my concerns. So, I've had both David and I have had an interesting relationship with them. So certainly, they have shifted the conversation onto this question of affordability. They've certainly started to intervene. That absolutely, because there was political leadership that said that there had to be a cap on payday lending, that allowed them to be pretty strict with payday lenders and to bring in a cap that clearly has made a difference. So, we don't have 18 payday lenders in Walthamstow. Payday lending still happens in this country, but it's been a halving of the numbers of people going with problems with payday lending to citizens' advice bureaus, which proves that you can have forms of credit that meet a need that are not predatory. The challenge for me with the FCA is it feels like they're repeating the same problem that we've identified with the Office of Fair Trading, which is the kind of big elephant in the room, which is, right, are you seeking to help people in problem debt, in which case when there's a crisis, or are you seeking to prevent problem debt, in which case you probably need to have a more muscular interventionist process. And I sit in meetings with them, and I'm sure you do too, and with ministers who constantly talk to me about the unintended consequences of intervention. Now, my frustration with that is I understood and took that argument in 2012-13 when we were arguing for a cap on payday lending because it wasn't a tried and tested model. We now know this works. And when I see new forms of predatory lending, like guarantor loans, like those Vanquis credit cards, I sit with ministers and I say, do you want another Wonga on your hands? And they sort of say, oh yes, but the FCA say to me that they haven't quite got the data yet. The FCA then also say to me, well, they haven't got the ministerial political backing, so they're very worried about litigious companies, because from my perspective, I keep going back to capping, and it's really important to say it's a cap on the cost of credit, not an interest rate cap. It's a cap on everything that you could be charged by any one of these companies. Is that we know what works, we know what levels the playing field. We also know that it means that the industry can continue, which I think is an important thing to say, because this is not about saying that nobody should ever borrow, nobody should ever be able to take out a loan. I think guarantor loaning probably shouldn't exist. That's a separate thing. But the credit card shouldn't exist. But it's about how you actually prevent people getting into problems in the first place. And the FCA at the moment, in everything they're doing, they want 5 years to prove that they can make credit more affordable, as in when people get into difficulty. So that's 5 years of people having to get into difficulties to see whether their regulatory approach is strong enough and tough enough. And I think both Damon and I have these full, frank and free discussions with them about, well, have you thought about modelling what capping would do? Because it's like a game of whack-a-mole. The people who own Vanquis and Aqua are doorstep lenders. These industries have just evolved around the regulation that exists. So the FCA bringing a cap on high-cost credit, and literally that cap is about short-term high-cost credit. So if you lend for longer than a month, you don't need to face a cap. I mean, it doesn't take a genius to work out what the successors of Wongas are doing. They're offering you slightly longer loans so that they can offer you at high rates to get around a short term. So, and the FCA itself isn't flexible enough, and I would argue interventionist enough to think about preventing problem debt. It's just thinking about what you do when problem debt occurs, and that for me is the problem with it.
I agree with everything that you've just said.
And that's why they won't meet us.
I think, to some extent, the Office of Fair Trading was dreadful in terms of it really just, it covered everything, not just consumer credit. It's the Office of Fair Trading about anything that's going on in the world in that sort of sense. And it was under-resourced. But secondly, it had an ideological commitment that things would be sorted out by the market, and that the market was not incentivised to actually lend to people who couldn't afford the loans, and it just completely missed what was going on in the development of consumer credit that I mentioned earlier, around 2000 and so forth. So it never had the willingness to act, and it didn't have the resources if it had the willingness. So nothing happened. quite rightly, Stella was behind the push for consumer credit to then transfer from the Office of Fair Trading to the Financial Conduct Authority when the FCA was set up. And that has been beneficial. Let's face facts about that. I mean, admittedly, they had to be forced to put the cap in place on payday lending, but they have gone and done some enforcement action. There have been some redress schemes. They have closed a number of lenders down. They have got, some supervisory activity in there, which has really benefited people. And we have won again to some degree with the rent-to-own cap, the cap on Bright House, which will be introduced shortly. That just has been introduced, I should say. So it is better, but to some extent there was just a changing of the name on the door. A lot of the OFT staff who had been working on consumer credit were then recruited into the Financial Conduct Authority when that was set up. And so there was a period of time when nothing really changed ideologically. It was just that they had to be seen to be doing something about payday lending.
Yeah.
And as that pressure if that pressure ever fades, I don't have much confidence that they would actually continue to do things. And I think that does come down to a sort of ideology around competition, around switching, around consumer behaviour being the focus of their work, rather than direct interventions on things that matter to people, like how much is this going to cost and how long am I going to have to pay it back for?
Has there ever been any work done or any thought to work being done? Obviously, I work for a local authority, so I know that every time you want to give something away, you've got to find the money from somewhere. So there's always that kind of quid pro quo. But if you were to cap at whatever level interest rates, the actual interest rates, and or buy up a whole load of unaffordable debt and let people repay that at a more reasonable rate or a zero rate, what the impact would be on the money that would go back into the economy, and people would therefore be spending VAT and other.
Yeah. There's quite a lot of studies.
But anything that's easy to read, something that's not going to take me.
Well, the concept is called sticky money, basically, that if you can keep money in a local community, it has massive multiplier effects, and that applies also for writing off debt. Clearly, this is a community that has huge amounts of debt in it, as well as huge amounts of wealth, because we've seen that over the last couple of years. If you can get more people spending locally and less people in debt locally, then prices and productivity and the local economy benefits. In terms of the sticky, I think there was a credit union study that showed about what writing people's debt off. There's various pieces of research, and I think even Bristol. So Bristol University have done a lot of work on debt. Some of it good, because some of it was used, some of it bad, because some of it was used to justify why we didn't need a cap, and some of it good, because it helped show what benefit writing off debt would do. It's a two-pronged approach for me. Like, absolutely, we've got a massive debt bubble in this country, and it's going to bite us. It's going to bite us really hard, because we haven't even mentioned the B word yet. And, when Brexit comes, and you've already had austerity. Imagine what's going to happen to people's incomes and people's ability to basically put food on their table.
Third B word as well.
Yeah, and the one group of people who will survive, like the cockroaches, are the predatory lenders in that kind of in the nuclear moment. But there's also something about how do we prevent problems with us, because I also look at this from a very human perspective. Like, the people who come to you, because there is this shame about being in debt, it's always going to hit them. They're always going to feel it. And I just think a really good government and a really good society wouldn't let people get to that point in the first place, because so much of it is geared to make it almost impossible for them not to get to that point. You see what I mean? That because these companies, and also because, as Damon says, they're not able to access other forms of credit. The JRF did some really good research about just how expensive it is to be poor in this country. And we are all ultimately going to have to pay the price of that, because the social and economic consequences of it if we don't. So for me at the moment, the absolute priority is to get the cap in place, because then we can talk about buying back debt, because we know that there's going to be a limit on the amount of debt that we've got to deal with. Right now, we don't have a clarity about what that 250 billion, we would, where it's going, how much of it is in any sense affordable, and what you can do about it long term. And it's a ticking time bomb under our economy.
Yeah, it's very it's strange when you think about it, but the industry itself is enabling for the worst reasons. It's enabling predatory behaviour. It's keeping people just on the cusp and to continue to go, but not really caring about anything else apart from as long as they get paid.
Yeah, except that it does have a massively deflationary deflationary effect on the economy, because money that could otherwise be spent is transferred as interest payments to the finance sector, where it doesn't do anything productive at all, generally speaking. And I think, in answer to your question, that LSE, along the School of Economics, have done some work on what the impact would be if we just had a debt write-off, a household debt write-off right across the economy, so that suddenly people woke up the next morning finding they didn't owe £10,000, they could go out and spend that money instead, and it would have an enormous boost to the economy, and it could be handled by the banking system as well, without the banking system collapsing. And I'm quite interested to know what your view on this is, Stella, both on whether this is, which is a policy that is being started to talk about, whether you feel that this is sort of, and it's obviously being talked about mainly obviously in the Labour Party rather than in the Conservative Party, whether you think it is a policy that will get any traction at all, and whether you think it's what you think
I absolutely think debt buyback is part of that model, but I actually think one of the challenges here is that those policy conversations alone presume that people will continue to live in debt. And one of the things that I am very keen to see is us change to that preventative approach and saying what is a reasonable price for credit. When I sit with ministers and I sit with the regulators, I talk about the sweet spot, because I do think we want to be in an environment where people can make money from lending to people, so that you have lending and it can be lending done in a way that works for people, but not in a way that drives them into debt. And actually it's not so difficult to design models that do that. So having got to the point where we've got this level of debt, clearly, because there are social and economic consequences far beyond anything we can afford as a public or private sector, we have to deal with that in itself. But as I said to you, until we've got in place the protectiveness of capping, actually we don't know what that would be. I also think there's got to be something done about what people are, or how people are borrowing. So it's not just about capping and it's not just about writing off. Why do I hate guarantor loans? Because what guarantors, everyone knows, so a guarantor loan is where you take out a loan and then somebody else acts and says, if you can't pay it back, I will pay it back for you. I have now a large number of cases in Walthamstow of people who have got into debt with a guarantor loan, but because they recognise it's not just them who's in debt, they're now getting their mate in debt, have made some incredibly risky decisions. Now, there is no cap that would stop that big, even if you made a guarantor loan more affordable, there's no cap that would stop the fact that these companies are benefiting from the social shame of borrowing and the social shame of lending. And in fact, one of the things I think is so egregious, and I've sat with the FCA repeatedly saying to them and writing to them about it, is that what I've seen with these cases is even when people have gone into SEC to get debt advice, so even when the original borrower has gone, okay, I'm in trouble, I'm going to try and get this sorted out, I'm going to try and get a debt relief order, the companies are still continuing to chase their guarantor as well, because that's the way they get a quicker sum of money, until we actually fundamentally change how we borrow so that it's part of life. It's not actually a shameful thing, but it's done in a way that isn't predatory. We will keep having to find chunks of money, we will keep risking financial institutions telling us that then people become too risky to lend to, which is how we got into the point where this subprime market appeared, and we'll keep repeating those problems. So there's a kind of cultural, practical and economic set of answers that we need to have. The main thing is it has to be a priority, because there's no way any economy ever really recovers and becomes productive when you've got this level of debt.
Yeah, but I suppose that's my point. These two they're not alternatives, but it's not as though we can solve for one and then deal with the other, because as you said, we face, given the level of debt, we do face a very potentially, another crash.
Sure.
Last time when there was a crash, we were perfectly happy to bail out the banks, and we could this time differently bail out the public.
Actually, I think those two things go hand in hand. But fundamentally, it stopped the banks foreclosing on millions of people in this country. The question for all of us then was that rather than the government saying, okay, now we need to invest in people, as we were trying to do in 2010, is they immediately said, right, the public have to pay off the debt. There are absolutely political choices about it. But I go back to, I don't think we should be in a position where borrowing in of itself is a bad thing to do. It's how you're doing it and how fair it is. Yeah. And where behaviour comes into that pattern. Because I do have people who will take out credit cards, who will take out and will borrow in a way and take risky borrowing, because they know that the credit card companies won't chase them, and they are responsible borrowers, and I think we should want people to be responsible about it. So we have to make sure that the system goes for a completely different behaviour and approach to money.
I think the biggest problem in getting a debt write-off at scale is the issue of moral hazard.
Yeah.
So how you select which debts are written off and which ones aren't is difficult. And there's a lot of public sort of attitude, which is, well, why should that person get their debt written off when they've bought, big telly with it or whatever, and all of those sorts of you get the daily mail sort of issues.
That's not insolvable, is it? Because
No,
the issue of moral hazard was solved overnight when we had to bail out.
Oh
the
yes,
banks.
no, I know. I agree with you. I agree with you. I'm saying that there is a problem in selling it as a policy. That said, there are potentially some ways around that. And I think you can look at the mechanisms for write-off, which I've mentioned. For example, if you're writing off debt that's already been sold on the secondary market because somebody's been in problems.
Well, it's
there's a
secondary,
chunk of-
tertiary, and
Yeah, exactly. Indeed.
Exactly.
So there are some sectors of the sort of debt world where you could actually sort of go, well, that's a prime candidate for being written off, or that is, or that is, or whatever.
Yeah.
So I think it just needs a bit of thinking through about all of that. There is no doubt that if we were to reduce the interest burden, the interest servicing burden on households, that would generate economic growth. One of the problems, and Stella's quite right, however, is that you still have the issue about how to prevent a further explosion of credit. So if you write people's debts off, they become kind of solvent again, and you'd go, well, they've got loads of money, let's lend to them again. So the two do have to link together. The one final thing I'd say is I think things are a bit more serious about the role of credit expansion in society than most politicians have thus far given it consideration, and that is when credit is created. When a credit agreement is created, banks create money in that process. So an expansion of credit is an expansion of the money supply, and that's inflationary. If you go pumping credit into an economy, that's an inflationary pressure. And we've been through a period when we've had loads of credit pumped into the economy. Technically, that's really inflationary, yet we've not seen a great deal of inflation. And the reason for that is that government's been taking the pressure out by cuts to public services. And the Bank of England has an inflation target, so it will raise interest rates, which then make it more expensive, and the interest burden grows on an expansion of credit. So the way in which credit actually affects the political narrative around, we can't afford it, we've got to keep inflation down, that whole sort of thing, and therefore what are we going to do to keep it down? We've got to make households pay either greater levels of interest or cut public services. And I think that's something that really needs to be got to grips with in the future.
It's a fantastic
I think there is a way forward on this, which is part of the other organisation we haven't really talked about tonight, which is the Financial Ombudsman. So actually, the Financial Ombudsman has then looked at where credit agreements are fair and where people are basically being ripped off. And I think the way forward on debt write-off is to start saying where you have industries where it's very clear that this predatory lending has happened, that's what you write off. You don't write off all forms of debt as a matter of course. You start saying what kind of behaviour have we seen that nobody could have got out of, so it just isn't a fair fight. And I think that changes the conversation. Where I think there's a challenge in our regulatory system right now, so actually in the last couple of years we've had a whole series of new bodies be set up. So you've got the Financial Ombudsman, you've got the Financial Conduct Authority, you've got the Financial Advice Services. We're not really bringing those together. And I don't know, so the Wonga case is a good example of this, and Damon and I again have been doing work on this, where the FCA went in to regulate Wonga when it was clear that Wonga was pushing people into debt. They brought in this crazy rule about they would only deal with existing Wonga customers. So anybody who'd already been ripped off by Wonga wasn't somebody they would help. It was the Financial Ombudsman stepping in and helping those people who'd already been ripped off by Wonga, and it was clear that they'd had an impact on it, that made Wonga go bust, because Wonga's pot of money for dealing with the problems at the FCA. And you think, well, if the FCA was supposed to be dealing with affordability and problem lending, why did it take the Ombudsman stepping in? So I think there is certainly something about how we use regulation and legislation to send much stronger messages about people being ripped off. Because it's people are keeping going in this country. We've kept our economy back on track by getting into debt. And if we're going to get out of that, it isn't just that we want people to have access to a lot more money, we want people to have access to money in a way that is manageable, that isn't going to create those same problems, and is going to send a message about the kind of credit economy that works for us. You know, all of this has been market failure, but it would be a further failure not to address the behaviour at the heart of this, and to use the power we could do if we were going to put money into writing people's debts off, to send that.
Mitch.
I'm just keen to hear a bit more about the total cost cap. Because it's something that I think you two have spoken a lot about over the years, but it's maybe not as obvious what it really means to everybody on first glance. And you also singled out, which is really important, the relationships between the lender and the borrower. And I'd like to know first, what are we capping? And then how does that have an effect on that relationship?
And before you do that, are there any more, because I'm conscious that we're conscious of time, is there any more contributions or questions we have? And we might just do a quick round of wrap up around the cap question. If not, we'll just focus on the cap question. I think maybe call it a night if that's okay.
I just wonder if there's something that, I don't know, some really good PR firm or something could get involved in. You know, 5 years ago, no one was talking about mental health issues. 20 years ago, no one was talking about being gay. What is there that can be done where you can just normalise the idea of getting into an issue, getting into debt? If you can, you know, if people are in debt and they are in problematic debt, and it's not necessarily what we would describe as problem debt, but problematic, that's the time to be approaching the CAB, to be approaching whoever, but people don't. We know they don't, because they're embarrassed and because they're ashamed and because people like me don't get into debt and people like me don't go and see the CAB. So what can we do, what can we get done to help normalise it? Like, you know, the behavioural science units, they're not something they can do a piece of work around that, or...
Yeah, so I mean, actually there is a new body that's just being headed up by Hector Sanz, which his job is to provide financial education and to challenge organisations that aren't being clear about how they're selling goods to things. And I met with him, but he himself was pretty clear that it's a kind of losing battle, because not because people don't take financial advice, but because if fundamentally there isn't a fair price of credit available for people, you're kind of waiting till people get into trouble. I think there is loads more we can do about financial advice. I mean, also we need funding. I mean, I wish we had 3 CABs in Waltham Forest again. I wish we had 3 in Walthamstow, because it would really help with a lot of people who need help to go through their budgets and before you get to a point where they're in debt. There's also a lot, I think, I mean, you said you worked in local authorities. So a couple of years ago, we ran debt advice training for local people, because we had a tower block in Lee Bridge that was about to be renovated, and so they said to some of the people, well, okay, your kitchen's going to be done, but like they had cookers that were being condemned, and the housing officer said, well, just go down Bright House and get a new one. And when one of the tenants told me this, I was like, ah! And actually, a lot of people who are not in debt don't realise what good and bad advice on credit is, because they've never had to deal with these circumstances. So changing that culture, like, again, the great thing about calling people legal loan sharks was I knew we were going to win the fight when a very fusty Tory MP said to me, Stella, your name was mentioned to me about this cash converters malarkey, what's going on? And it was like I was able to have a conversation with him about that. Actually, this is how people do, because in his community they just got a cash converters and it was completely extraordinary. You know, stopping thinking that this is only a problem for people on low or variable incomes, because the data shows that level of risk is now across a lot of people on a lot of middle and high incomes as well, but also turning it into everyone's business to make sure everyone gets a fair deal. Because I think people see it as a personal behaviour thing. Well, I didn't get into debt, so you're obviously deficient, rather than going, we will all pay the price. Is a casual. You asked about the total cost cap.
So maybe if I get Damon to...
No.
So it was me and Damon who invented the total cost cap. But we invented the total cost cap partly because when we first started talking to people about an interest rate cap, everyone said no.
Yeah.
And actually it was Martin Lewis, the personal finance guy, that we met. I don't know, were you there that first? I had like a long conversation about why he was opposed to an interest rate cap, and I remember ringing you and going, he's got a point.
Yeah.
And he had a point for a number of reasons. One, because with these companies, often it's not just the interest rate, it's all the added charges.
Yeah.
So if you get into debt with Bright House, they'd slap on an extra charge. So if you just cap the interest rates, all these companies would just start charging extra charges. So we had to work out a way of capturing everything.
Yeah.
The second point would always be Damon's point, is the thing about the relationship people get into, because what you want to be able to do is say not you can never borrow, but if you are borrowing from Wonga or if you're borrowing from Vanquis, at some point the debt is going to finish. So at some point you will be able to get out of this. And the point about total cost capping is at some point they stop making money out of you because there's nowhere else they can go with it, which is why it is a panacea for a lot of these problems. Because if you're lending in a predatory way, you're keeping people locked in, and you're keeping people locked in because even if you're only making a couple of pennies out of them, you're still making a couple of pennies out of them. You cap them, it stops, but you can only do that if you include every single charge in it.
That's absolutely right. The other, just the very last bit that was really important about it was that it includes refinancing.
Yeah.
So the rules are, I mean, 100%. We can argue about where the cap should be. Should it be 100%, 80%, 60%, whatever. We can argue till the cows come home about exactly where to put the line. But the fundamental principle of it is that it has to include all the costs so that people can't just evade it with sleight of hand, as Stella says, around fees, charges, or different terms for things, or that sort of stuff. That's really important. And secondly, that it has to prevent companies from simply going, oh yeah, we've charged you 80% on that loan, and now here's another loan that pays that off, and we'll charge you another 80% on that bit, and all of that sort of stuff. So it was absolutely critical that it included a refinancing provision. The problem with that refinancing provision is that it only seems to be being applied to the same company.
Yeah.
So if I'm Wonga, now gone, but if I was Wonga and I want to refinance a loan, then the 100% cap would accrue as each loan was financed, and eventually you get to the point where you couldn't refinance that loan anymore and stay within the cap. However, there's nothing to stop another company coming along and basically refinancing that loan, getting 100% back on that, and then somebody coming along at the end of a period of time after that. Anyway, so cycles and chains across different lenders do not appear to be being prevented by the refinancing provisions. Now, in my interpretation, I've written to the FCA about this, my interpretation, the provisions should stop that. The difficulty is that nobody but the lenders or the borrowers actually can see those chains. Recently, the FCA has written to chief executives to say it is aware of problems with lots of chains, and the Ombudsman's reporting that people have got all these loans out with different companies and they seem to sort of fit together in these refinancing chains, but they've not as yet said that they've got the powers or written the powers properly to deal with it. So we are taking that one up. But fundamentally, it was a long haul to develop the total cost cap, and it involved looking at all sorts of caps that had been used in previous countries over the years, the States, in Europe and so forth, and looking at the pros and cons of what they'd done and what they hadn't done. In the end, we took I
think it was Japan, wasn't it?
Yeah.
But you have Martin Lewis to thank for being initially very against what we were doing, and that's a good note to end on, because it's about look, the role that groups like the Fabians play, the roles you can play, is we have to stress test all of these, because we're up against this idea that somehow unintended consequences are more important than the reality of what is happening. So the only way to get through that now is to have an absolutely rock solid, it was only having a model that even the Treasury officials kind of went, I could see something in this, that finally got, that and winning several votes, or coming close to winning several votes in Parliament, and George Osborne knowing that we'd have won the fourth time round. But it isn't, it's a much harder argument to make, because our finance industry is so well embedded into our economy and is so clear that it's acting against the market. And the reality is it doesn't always do that. Where it does do that, great, because actually you can read signals, and we haven't talked tonight about real-time credit checking, which is the other thing. The last thing for me, when I meet a man who's got 4 credit cards and owes £40,000, and I think, who authorised all of those? Because you should all be sharing data, and you should all be able to see that this gentleman has taken out that level of debt, so he's never going to be able to pay it off. But again, that's not regulated by the government in a way that would actually mean that it was looking to spot the patterns of predatory lending, to say, what are you doing? Or I think it was Cash Advance and Cash Payday who were sharing consumer data to allow people to, so this Wonga might have gone, but the ethos lives on.
Absolutely.
I think it's a good place to end. That's been incredibly insightful and a very big deep dive as well. I think a lot of people, when they think about debt, they think about the actual debt, how do I avoid it? But I think what was really helpful about this for me as well was to understand about the behavioural mechanics behind all of this, about how it shifts away from how do I make ends meet to how do people respond to know that I may be in debt, and how we treat debt, which is a much wider conversation and one that can be tackled in many ways. So my thanks to both speakers and also all contributors. Would remind everybody we've got lots of great events coming up that you can read up more on our leaflets, and I think you can help yourself to some teas and coffees and refreshments as you leave, but we are wrapping up pretty shortly. So, and also thank you very much as well to Christopher for showing us an extended trailer of what seems to be a really fascinating story and tale, and to be watching it in the venue that all took place as well. So my thanks to Christopher as well. So thank you all very much. Good night.